The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Welcome to Stock Take. My name's Gaurav Sodhi. Joining me today is analyst Graham Witcomb. Hey, Graham.
Hey, Gaurav.
And with us also is analyst Nick Cummings. Hey, Nick.
Hey, guys.
Well, guys, we're back together. The team's here. The kids are no longer in charge, although sometimes the kids are the adults. And I'm pleased to be back. Thanks for covering while I was away. I went to a family holiday right in the middle of reporting season. But it could not be helped because we went to see a concert, and the concert's on when the concert's on. No
one waits for Taylor Swift.
No one waits for Taylor Swift. Yes, that actually should be the name of one of her albums.
Wait, Taylor Swift waits for no one. I mean, I said it backwards.
I get what you're saying. So I've returned to this hailstorm of corporate events, results, and chaos. We're slowly making our way through it. But now, speaking of chaos, I think we should begin at MinRes because, my goodness, when I left, this business was like, I think it was more than $60. And I thought, looks kind of cheap, kind of interesting. I'll look at that when I get back. And I get back and it's under $40. And it's probably interesting to discuss what is happening with MinRes. So before I delve into my bit, Nick, do you have any idea what's going on? As kind of a interested layperson, what are your thoughts on it?
Yeah, I guess, like any miner, you do have to take a view on the commodity price. And I think here the market is extrapolating these lower commodity prices, for longer. And they're worried about MinRes's debt. They probably don't understand the structure of it, as I'm sure you'll speak to. All the options that this company has. I mean, I was sort of taken aback that they sold a dirt toll road for $1 billion, but apparently there's all these other little options.
That's a 49% of that dirt toll road for $1.3 billion.
1.2, yeah. So there's all these other options there, I think, that can sort of realize value and get them through this period. But the market that seems to be dismissing it at the moment. And I think the debt here is the main focus, because if you look at Pilbara, who are net cash, but in the lithium space as well, they haven't fallen anywhere near as far.
Yeah, so, although they have fallen a long way. So I think they have $6 to in the late twos, so that they've had a big fall as well. But you're right. Yeah. The problem, I think what the market is concerned about. So first of all, we're going through a vicious cyclical downturn in lithium. And that's been ongoing for about a year now, and prices have fallen by about 90% peak to trough. We're now in a situation where not many lithium mines in the world. Like in Australia, there's probably 2 lithium miners in the entire country that are making profits, and that's Greenbushes and Pilbara's mine. Overseas, Tianqi, I think Tianqi is the world's largest lithium miner. Maybe it's SQM, but it was one of the world's largest. They actually announced losses. Albemarle, one of the largest, has announced losses. There aren't many mines currently making money. And I reckon about 2/3 of industry capacity is currently at loss-making or break-even at the moment. And by break-even, we're talking about sort of an EBITDA level, not including royalties and depreciation and capital charges. So if you include that, it's got to be close to 70% of the global mining capacity is loss-making. So we're deep into the cost curve now, and I think it's only a matter of time before we see capacity cuts and a restoration of prices in lithium. But lithium isn't the only concern for MinRes. They've also building a big iron ore mine. And look, iron ore prices, this is where I'm a little surprised. I suspect there's still not a firm understanding of the transformation MinRes is going through regarding iron ore. MinRes used to be the highest cost producer of iron ore, probably in the Pilbara. They used to be sort of $100 a ton costs, and they were really marginal, and they only came on stream when iron ore prices were exceptionally high, and they usually shut production when they were low. And the market for the last 5, 6, 7 years has known MinRes as a high-cost, low-quality iron ore miner. Now, they've changed that with a large investment in a mine known as Onslow. And Onslow is a genuine transformation of their iron ore mining capability. It raises production a lot. It slashes costs by more than half. So instead of $100 a ton, we're now looking at about $40 to $45 a ton for mining. You add in shipping costs and royalties. I reckon you'll be shipping Onslow ore $65 to $70 Aussie. The price now is $92, $93 US. Can anyone do some quick math? What's that? That's 93 divided by 0.7. It's $132. They're still making close to 100% margin on their all-in cost of Onslow. And it's actually probably better than that, because under the agreement of the joint venture, they own 60% of the actual mine, but they've paid about 90% of the upfront costs, so they can claim 90% of the cash flow for the first 1 year or so of operations. So they're actually going to be getting accelerated cash flow from that mine. And even though iron ore prices have fallen, this mine is still deep in profitable territory. When MinRes delivered its numbers, they said that at $70 iron ore price, US dollars, $70, they can still make a 20% return on invested capital. It kind of shows you the resilience of that iron ore mine. And you look at that share price and you think that resilience is certainly not reflected in that share price. And I think, Nick, the reason for that is because as you said, the debt levels have frightened everyone. And I can understand that. It is a lot of debt for a business this size. So debt will peak at about $5 billion or so in the next few months. And this is, an $8 billion business? So that looks terrifying. If you're the miner of a cyclical business and both your commodity prices are falling and you're holding, 70% of your market cap in debt, that is scary. However, the base business of MinRes is a mining services business, and that is just a wonderful quality business. I think the market is starting to appreciate just how good that business is. It's a mostly crushing company, so they're the world's largest independent crusher. They crush for the best iron ore mines in the world, the best mines in the world, and they just clip the ticket on volumes. And crushing is something that continues irrespective of price. There has to be iron ore prices would have to get to sub $30 a ton, which has not happened for, since 2002, 2001 for iron ore, for its crushing customers to cut production. So look, that business delivers an awful lot of steady, stable cash flow. And the cash from the steady part of the business should be enough to service the debt alone. And that's because the structure of MinRes' debt is quite unusual. They don't have covenant high bank debt. They've gone into the US bond market and they have raised money in that market. And in fact, if you look at what the MinRes' debt is trading at, it's trading at par value. Now that means that none of the bond traders in the US think that MinRes is in danger of defaulting on its debt. Yet the equity traders are treating the equity as if MinRes is in a lot of solvency trouble. So someone's right, someone's wrong. I reckon
What's the saying? The bond market's always right?
Bond market is always right. If that's not a saying, it ought to be, because that is, yeah. I reckon the bond guys would have done much more rational work than the equity guys. So yeah, not only is the sort of the quantum of the debt manageable, but the repayment cycle is also really attractive because not a single dollar is due until 2027. Onslow reaches full capacity June 2025, and they harvest, as I said, 90% of the cash flow from that mine in the first 12 months or so. So, look, I'm pretty relaxed about that debt level. I am very surprised by the market's reaction to this because when you look through it quite logically, there doesn't seem to be too much to worry about. But there's no denying that share price fall is immense and it can be scary. But I think I've had a lot of experience in dealing with resource companies. So a share price falling by half in short order is kind of
par for course.
It's what happens in this industry. I've seen it a lot. I'm surprised to see it in a business that appears to be quite well fortified, and so that surprises me a little bit. But I guess those animal spirits can be hard to contain, and this is a sector known for its wild swings, and so it is proven. Do we have any questions on MinRes? I think this is one that a lot of people have been worried about talking about.
I guess just you spoke about the mining service business. What do you think the value of that business is? Like maybe a per share value, just a ballpark.
Yeah. So let's go through the numbers. So they're doing 550 in EBITDA now, and with Onslow, by in the next 2 years they'll be doing $1 billion in EBITDA, and that is high quality earnings, sort of back. I think the average contract life is 30 years. These are life of mine contracts on some of the best mining assets in the world. And
that's before the debt repayments though, right?
Yes, correct. Yeah. So that alone, so you'd put that, I think if you're conservative, you'd probably put that on 6 times, but I could easily put that on 10 times because it really is an infrastructure business. So that alone is worth $6 to $10 billion.
Which is the market cap today.
The market cap today, I think, is probably fallen below 8 now. So
yeah, okay.
You're really getting you're really paying for the mining services business only. And as a reminder, we just did a quick bit of math on the iron ore business. Like at $80 a ton, they're making close to $1 billion in EBITDA. Just for the iron ore business, and the lithium business is a top 2 lithium miner globally. In terms of spodumene. So it's a lot of freebies you're getting there. They also have a large gas position in WA, and it's quite conceivable they could be exporting gas or build processing plants there. And the other plan they have, which has not been fleshed out yet, but is kind of a thought bubble at the moment, is to replicate the crushing business for iron ore in the goldfields of WA and do that for lithium as well. So they could end up growing a services business in WA where they process spodumene concentrate for small lithium miners, and that's there's no value on that or on the gas business, but there are just some options for where this business could go. So there's a lot of assets on that balance sheet. There's a lot of control they have about how they spend their cash flow. They've been extremely aggressive about spending cash, and I think now you'll see them slowing down that cash burn a little bit. So there's a lot of levers to pull here, and I think the panic seems a little premature.
Yeah, and I guess it's all overseen by what's his name, Chris Ellison, who's a bit of a maverick or a larrikin, but his track record is second to none. It's quite incredible. I wonder if that's playing any role here, that I feel like Mineral Resources, compared to a lot of other mining companies, is sort of owned by maybe sort of quality investors a little bit, that maybe I listened to a podcast that was on, I think, Business Breakdowns on it, and it seems to me that there's a few investors that own Mineral Resources or have owned Mineral Resources that aren't actually resource specialist investors, and maybe some of me wonders that some of those investors are getting a bit spooked.
Yeah, no, I think, well, if you're a traditional investor unfamiliar with the resources and you look at some of these metrics, it looks scary. And if you're just valuing on a PE basis, it looks scary. But it looks scary because they've just deployed $4 billion of capital on which they are earning zero return right now. But that capital will generate a decent return. We're just waiting for projects to ramp, which is very familiar and an easy thing to say for someone familiar with this sector. Yeah. But if you're a non-specialist in the area, that can be scary, and it does not screen well. In fact, if you just look at a PE basis, it looks awfully expensive still. But I think that's a reflection of cyclicality in its two commodity markets, and the fact that big project hasn't started up yet.
And it's the opportunity.
It is. Now, I hasten to add that whenever there's debt, there is every opportunity for things to go wrong. So I certainly don't think one should have, I think we're recommending a 5% position here, and I think that's about appropriate. Every time you have debt, things go wrong. Yeah, they're building a new project, things go wrong. So if I was to conjure up a disaster scenario, it would not be difficult. The disaster would be something goes wrong at Onslow, whether it's a cyclone, a storm, an earthquake, an operating error, something happens in the US bond market, some sort of external event happens to stop cash flows from Onslow Iron Ore, that would be difficult for the business. At that stage, they then have to probably sell assets or raise capital. I feel like that's a low probability event that is being priced at a near certainty. And I think that is probably the opportunity. So we're not talking about a risk that is unimaginable or impossible. We're talking about a risk that is, I think, being priced incorrectly in the equity. And again, I point to the bond market. If the bond market is not at all concerned about MinRes debt, the equity market seems to be obsessed with it. But my goodness, I've been talking a lot about MinRes since I got back. I feel as though I've gone away, and the only thing I've discussed is lithium and MinRes. Let's move on to something else. Actually, Nick, while I was in London, I did notice that London property. We sort of Sydney-siders are used to thinking that Sydney is some property hellhole where everything's unaffordable and people are obsessed by it. But that seems to be the case in most capital cities around the world. And it was certainly the case in London. Talk to me about Rightmove and REA and what the heck REA is doing.
Yeah, well, I mean, I was shocked when I opened the announcement on
yes,
Monday.
I can imagine. I was actually thinking about your reaction because we've spoken about REA and its conservative, well-managed business, and all of a sudden,
yeah, that's right. And we've been pretty clear that we think Rightmove, the UK sort of equivalent of REA, has been, it's really cheap and very cheap compared to REA. But I never thought REA would agree with us and I guess lodge their interest. But it's a bit of a change for REA here. So they've, for the last sort of decade, they've got out of Europe. They've recently accepted a bid for the Southeast Asian business. I think that's Property Gurus. They've still got India, but for the most part of the last decade, they've come back from overseas and focused on the core business. And this seems a bit of an about face, and it's a bit of a change in strategy if they do in fact lodge a bid, because Rightmove is an excellent business. This is a mature operation, 85% market share, 70% operating margins, just as much free cash flow and profits as REA does. Whereas a lot of the classified businesses from Australia have taken their profits from their core market and gone overseas and look for these sort of more immature operations that have lower margins and where they can bring their tech and their know-how and really improve them. Whereas that isn't the case here. There's an argument Rightmove's just as good a business as REA. So it's sort of hard to understand the rationale here, apart from they're just REA's using that 50 to 55 times multiple to just buy a great business that's trading a lot cheaper. I think Rightmove was around 20 times earnings before the news came out. So
you can see how this would be pitched by bankers, right? You can use your equity at 55 times to buy a business. And the problem with REA is that most of the time when they purchase a business, they're diluting the quality of their own business. But this is not the case here, right? They're buying an equally as good business at half the price. Like, it seems, is that an attractive strategy for you, Nick?
I mean, not really. I mean, it's hard to see what economic value they're bringing. I mean, I think if you take a step back and look at the rationale, so cost synergies, I don't think there is any virtually. I mean, Rightmove's tech platform is excellent. Again, 70% operating margins, extremely efficient. That's higher than REA's. So I don't think they're going to be able to strip out many costs. Maybe the board, but they're going to have to pay more than $10 billion for this asset. So that's a small change. And then on the revenue side, can they potentially drive better revenue? Like, maybe. The two big differences between Rightmove and REA in terms of the business model is one, how it's monetized, and then two, how close they are to the transaction. So if you look at how it's monetized, Rightmove chooses an agent subscription model. where the vendor doesn't pay for marketing. So the marketing cost is included in that agent's commission. And the advantage of this model is because it's a subscription model, and it's pretty much an all-you-can-list model, that when home sale volumes change or fluctuate, Rightmove's pretty insulated from that. So typically each year this builds on the last year in terms of their revenue. REA, or the Australian model, is completely different. So REA, the vendor actually pays for these advertising packages, and that means they can push price a little bit more because the real estate agent just pretty much passes it on. But obviously the drawback is REA's revenue fluctuates more with home listing volumes. But the big advantage for REA is the take rates are much higher than Rightmove. So if you just look at last year, in Australia, we sold around 670,000 homes. And I get that some wouldn't have sold, but just take that number, for example. REA made $1.2 billion in property and online advertising out of those 670,000 sales. That excludes financial services and the Indian revenue. Whereas Rightmove, the UK, they sold about 1.1 million homes, and Rightmove made less than 700 million Australian. So you're talking about UK sold 40% more homes, but Rightmove made about half the revenue that REA did. So if REA could switch that model to a vendor-paid model, then potentially they could really accelerate Rightmove's revenue. The problem with all these...
Surely that's the opportunity, right? The Australian model seems attractive to agents as well, because the cost of the service is a pass-through cost.
Yeah, it is the opportunity. The only drawback or the pushback to it is, Rightmove has been excellently run. Like the management aren't idiots. They've chosen to go this way, or the UK market has chosen to go this way for a reason. It might be just that's how it always was, and why change it? But it's not easy to change, a business model that's been, in place for a couple of decades. So I don't think it's as easy as going, we've found this new business model. Rightmove knows this business model. Other property portals in Europe use it. It's the well known that you can raise your take rate by doing this vendor paid model over time. But yeah, it's just it's very, very interesting. And the other one too is that REA could accelerate moving Rightmove closer to the transaction. This is what Rightmove have already hinted that they're going to do. And this is more so pushing into mortgages, more into commercial and rentals. So REA has done a great job at this over the last decade. I think it started with a deal with NAB, and then they bought Mortgage Choice. And so with this comes, greater revenues, lower scale and lower margins, but it brings more eyeballs to the platform, and maybe they can accelerate Rightmove's move into, or moving them closer to the transaction. That's the other big revenue opportunity. But again, I think come back to the start, it's hard to go past that this is just a big multiple buying a smaller multiple.
Yeah. And historically, I think the scary part is just the announcement. At first terrified me as well. Whenever you see big transformative acquisitions at this size, it is scary. An Australian business venturing off overseas is scary. Graham, you also lived in another property mad city as well. What's your thoughts on what REA is doing? Would you support the move, or do you think they're making an error?
It doesn't surprise me, particularly with even if you don't see much benefit from combining the business models or stripping out costs or anything like that. I think managements always do have an incentive to try and grow the business through acquisitions, because their own pay is going to go up more than the dilution for shareholders or the change in profits and that kind of thing. In this case, I think that it probably makes even more sense because they're buying a business that is low risk for them. It's not like they're trying to expand with some marginal company in the industry or anything like that. So I can imagine from management's point of view, it was a pretty easy conversation when the investment bankers kind of proposed it. Yeah, but I don't know. Nick has a better idea of the valuations than I do, so yeah, I'll defer to his judgment on whether it's a smart move for the current shareholders.
Yeah.
Yeah.
I actually don't mind it too much. I can see what they're trying to do here. And I think the opportunity from switching models is probably worth pursuing. We have to remember that Australia was the market leader. We invented this kind of business. We were the first in the world to do it, the first in the world to perfect it, and the first in the world to make it super profitable. And so it kind of, I can see the why you'd think you could go into another country and alter it, because we've done this several times across several industries in Australia.
And I also think, as much as Rightmove can look over the pond and say, oh yeah, Australia's doing this, but we just disagree, we're going to do it our way, I think they're also probably captive to what they have done historically, because there's a lot of risk in changing. You don't want to be the management that tries something new and stuffs it up.
Well, imagine they've probably been looking at what Zillow's done and thought, we don't want to be them.
Yeah.
But they tried to completely change their business model and were thumped for it.
Yeah. So they may well agree that the Australian model is better, but they can't do it on their own. They do need someone to come in who's, I don't know. Well, you wouldn't say they're impartial, but they don't have the same kind of egos tied up in the existing model.
Nick, what do you think the chances are of the deal actually happening?
Well, they've got 30 days, so I think it's September 30th. They've got to let Rightmove know if they intend to make a bid or to walk away from the deal. I don't know. It's a hard one, because this news was obviously leaked, and then they've had to come out and say, yes, we are interested. I think they probably would have preferred to announce just a bid, because it's going to involve, cash, probably some debt, and either an equity raise or issuing Rightmove shareholders REA stock. So, REA's price has gone down, I think 7 or 8%, and Rightmove's is up 25%. So there's already been a big differential, but I don't think that's too much of a problem, because I'm guessing they'll just base it off the deal price based off what it was prior to the news coming out. But I don't know. I'd probably say 50-50. It's really, really hard to know, and I wouldn't rule out another bidder coming out for Rightmove either. So
you've got really?
You've got the American giant CoStar that they're very cashed up, and they're larger than Rightmove. Larger than REA. They're probably around a $40 billion Australian business, and they've already made a commitment to invest in the UK. They bought on the market last year. I don't know if they would like REA coming into their territory and taking out the market leader that they've tried to displace. So maybe they make a play. There's also private equity, though. The argument there is, why haven't they got involved? Prior to this, but So I don't know, 50-50 if you put a gun to my head.
Okay. Has there been any reaction from management? Are they supportive, or have they been defensive?
No, they haven't received a bid yet.
Oh, that's sorry. Yes, you're right. The bid
they've pretty much just said that.
We'll wait for the bid.
They're refreshing the fax machine.
Yeah, I wonder what happens if REA has to raise a whole lot of equity, because they've got News Corp as their sort of 68% shareholder there. Do they get diluted, or that's interesting as well. Maybe that's a motivation to get rid of, to dilute News Corp a little bit. I don't know, but it's a weird scenario when you have one large and unusual shareholder sitting there, and not sure REA is thrilled to have them there. Although the integration with the print seems to be beneficial, doesn't it?
Yeah, and also, I'm guessing News Corp has given their blessing.
I'm sure they have.
they own 60% of the business. They essentially control the company. So, I'm sure they're supportive. I guess if they did raise equity and News Corp didn't participate in that raise, that REA's actual share within the indexes would go up because their shares are a lot lower because they've got their shares are a lot lower compared to their market cap because they've got a large owner there. So I think car sales, for example, is actually a bigger component of, say, the ASX 200 than REA.
Okay.
So there would be actually probably some forced index buying if that float did increase.
I reckon the rise of these index funds does actually influence management quite a lot, because I've heard managers say that, if we get bigger, index funds will have to buy us and our multiple might go up. Well, I guess we can call it the CBA effect now. It's hard to imagine anyone buying Combank on fundamental grounds. It's really this structural, automated buying that's been pushing this price higher. And I think that's playing on managers' mind a lot. We've got to be really careful about that, which is why a long-term owner-manager, or someone who thinks like an owner-manager, is still the gold standard, which you really want to look for.
Yeah, and I guess the CBA thing is just, it's all a bit crazy, but REA are buying a business model like Rightmove, which was at 20 times, and CBA trades at 25 times.
Yes,
and,
that's a good point.
One's doubled or tripled their profits over the last decade, and the other one's stagnant. So, yeah.
Wow, that really puts it in contrast, doesn't it? That's amazing. Wow. I don't even know if we had a segment on CBA. I think it'd just be all of us laughing, or all of us guffawing, or very short, crying maybe. Yeah, if we don't own it, crying. Now, going from one gamble to another, Graham. The perfect segue falls to you. Let's talk about Tabcorp.
Yeah, it was. When I was thinking through the different results and which would be the most interesting, I got to say Tabcorp's stood out as being quite an interesting result this year.
I was surprised you chose that one, I have to say. Not what I thought you would have gone with. That's
I don't know. It just had some some strange things. There were lots of aspects to it that were different. So the big one was that it wrote off $1.4 billion from its wagering business, which is a big number for any business. But for Tabcorp, which has a market cap of only $1 billion, it's written off more from the value of its business than its current market cap, which was interesting. But so management kind of gave the typical excuses of a slowing wagering market and inflation, and it was all kind of very airy-fairy, I thought. But I think the bigger aspect to it is that it has a brand new CEO. And this is a pretty common accounting tactic that new CEOs use, which is they write off a ton from the business. That then improves profitability for going forward. So by writing off all that goodwill and intangible assets now, Tabcorp's going to save $65 million or so each year in amortization charges, which is then going to boost net profit. So immediately by doing this big write-off, the CEO is working from a position of strength in that the company's profitability on paper is going up, even if the economics haven't changed at all. And the other thing is that it's written the kind of assets down to hardly anything, which means return on assets and return on equity is going to go up as well. So the CEO is coming in, hasn't done anything to change the business, but is instantly improving all these financial metrics, which part of his pay is probably tied to. I'm not sure, but there's a good chance that it is. And yeah, the business hasn't changed. So it's an interesting result because nothing has really changed, and yet from the CEO's perspective, tons has changed. But the underlying result was also weird for this other reason, which is that over the past kind of decade, Tabcorp's been a story of retail and on-track betting declining while the digital division has been growing in the industry overall. Whereas this result kind of flipped it. It was although total turnover fell 4%, most of that was from digital turnover, and it was the retail division that was able to kind of hold it up a bit better. So yeah, just an interesting result because of it flipped the trend on one side, and at the same time there were all of these accounting shenanigans on the other side.
So this has been a long-term disaster story, Graham. And I remember when this floated, actually, I think it was in the 90s, it floated to a whole bunch of fanfare. And it was probably a much better business back then, particularly when it merged with Tats. What do you think, when you look at the trajectory of what's happened at Tabcorp, where it was compared to where it is, what do you think's really gone wrong?
Well, Geez, that is a whole story.
It sounds like you're sort of settling in for a long answer.
I think the number one thing went wrong is actually the business. The business isn't that bad at its core. I think it's had some dodgy managers, which doesn't help. And then I think that previous management was just obsessed with adding debt, which caused all kinds of issues. And also the company has started from a position of monopoly, which just led to a complacency when the digital wagering kind of took off 10 years ago or 15 years ago now. And so it's been this constant game of catch up where it didn't really take digital seriously until more recently. And so I think between those factors, it's been it's always had its kind of issues. But I mean, this is still a pretty big business with a good market share, and I think it has lots of things going for it. So although it's had a rough time over the past decade, I still have some sort of hope in the company that it's able to turn itself around, and with the right management in place, it can. And so we'll see what happens from here. It's just renewed the Victorian wagering license at a phenomenal deal. So that'll instantly add 100 million to operating profits, and that was just a steal for reasons that we went into in the articles. But so I think its best days are ahead, but I've said that for a while.
Nick, any thoughts on this one?
Not so much on Tab, but I've previously looked at Flutter Entertainment, and they own Sportsbet as well as some assets in the US and the UK and Europe. And one thing that management always say, or that their management always says, is that they think digital wagering is a winner-takes-all market, similar to similar to REA and Domain. So whatever the market share is, 90% of the profits sort of go to that to the biggest player. And if you look at the last sort of decade in Australia, Sportsbet's come up. It's sort of played out that way a little bit. Sportsbet by far make superior margins compared to most of the compared to the rest of the competition. So I think that's this one thing that to be watchful of. I also think that an investment in Tabcorp or any of these sort of online bookmakers is it's going to be heavily dependent on what the regulatory outcomes are. With potentially a banning of advertising, all those sorts of things. I mean, this is a model that has relied on heavily on advertising, and whether turnover falls if that comes out is sort of an unknown. But my guess is it would. But on the other side, you probably entrench the current players into their, so virtually it becomes an oligopoly between pretty much Sportsbet, Tab, and Ladbrokes, because no other company can advertise. So it's actually similar to what happened to the cigarette industries back in the 80s and 90s, I guess.
I have one other question for you, Nick. Did you just say oligopoly?
Maybe.
Yeah, no, that's actually quite interesting. Flutter is one that I know you've had a look at it before, but they look like to be in a very strong position. Actually, a lot of the competition has fallen away. So I own PointsBet, which we've discussed internally and disagreed about internally, but that's their experience in the US was terrifying. They threw away so much money. But I think now coming back to Australia, it's a very different business now, much more disciplined and organized, and simply making a bit of headway. But this is a much tougher business than it appears to be. All those spreadsheets and presentations about endless growth, much harder to come by in real life. Now, speaking of real life, gents, we better get back to ours. We've got reporting season updates still coming on the website. I think we'll probably have those for another week or so. And then John's got some articles he's working on, especially he's doing a roundup of reporting season with all of us involved. So keep an eye out for that over the next week or so. Good to be back. Nick, thanks very much for your time.
Thanks, Gaurav.
And Graham, thanks for you.
Thank you.
I think I said thanks for you. I think I meant thanks to you. That probably makes more sense. With this, see, Nick, you don't have the oligopoly on audio errors. For everyone else, thank you for listening.